That's the beautiful thing about
Exactly, yeah.
Bitcoin. Every possible scenario I've tried to imagine where something can go wrong, I realize there are incentive structures or there are corrections already built into the system.
Exactly.
It is incredible.
You can see the writing on the pavement. Young kids that growing up in
You have this framing where you have government on one end and you have Web3 on the other. So any kind of crypto on the other.
Yes.
And you say they are very far apart, which I agree with. If the vision of cryptocurrency works out, if the vision of Bitcoin especially works out, then the government will end up losing a lot of power.
Yeah.
Because one of the biggest ways in which the government exerts any power on us is their control on money itself. So this I agree with, but you said that the solution lies somewhere in the middle.
Yeah.
Do you have a conception of what such a solution would look like?
So first of all, what Bitcoin and crypto enables us is trustless, right? So right now, if you see in the world, like the global economy is controlled by like different governments, and then there are some powers which have higher stake and some have lower stake. So already it is not something that is controlled by one entity, right? It's decentralized already by different governments. Now inside each government, it has complete power over its money, right?
So you're saying within a country, a government has complete power
over their economy.
Yeah.
But different governments interact in a decentralized sort of manner, right? And it works as a market, money market, or international money market, you can say, right? I think like the first major thing would be to solve the international payments, because it already is it is a market, right, where the money moves between. So I think the first step might be the international market, where you can implement blockchain to help ease out the payments to another countries with whatever laws each local government has, right? I think from a tech level you can do that, so that everyone is on the same system, and then they can implement their laws on top of it, so that their economy is sort of safe, so that you are working inside the legal laws. So I think the first low hanging kind of fruit is that. The other thing would be like, it is, I know it's against the philosophy of Bitcoin and the other cryptocurrencies that are there, that there should be no control. It should be completely decentralized, and I don't think that is the way you can go right now.
We'll get to that. That's the most interesting bit, I believe. But what you described about the current utility of crypto is in DeFi. So how is that different from something like a fintech company that is not crypto enabled, that is still working on the traditional blockchains or creating other new traditional blockchains or figuring out smart workarounds in the current system and then providing similar services? So there was a time when transferring money abroad was a lot more tedious than it is today. It would take longer, it would cost more, there would be more checks and balances in place. Now it's easier. It's still not very smooth, but it's easier, and the direction is obvious. It is getting more and more easier. So what would be the value proposition of DeFi in a world where traditional finance is already getting much better very quickly?
So first of all, I think when you talk about traditional finance, it's basically banks at the end settling the transactions, right?
Correct.
And then there are multiple layers of fintech companies providing different kind of solutions. So again, you don't know where your data goes, right, in the whole loop. So like there are some fintech providers which are giving embedded finance solutions, and then there are consumer facing fintech apps which offers the services directly, and then there are banks which they are partnered with, and those banks have partnered with their foreign. So it's a long chain of loop which you can see, right? And if any chain which have multiple weak links, then it can be exploited easily. So that's why when you hear that like different scams happen, obviously like different exploitations are there on the traditional network, like the chances are a lot more. Obviously it is much strengthened, but like fundamentally it is easier to exploit it.
This sounds surprising, because my image at least is that the traditional network is safer in that way because there's a lot of checks and balances in place, and you always hear about some or the other crypto scam, some or the other person or exchange getting hacked. So why are you saying this?
Again, this is again, like, that's why that happens when you combine the whole Web3 world into one and everything into that, right? I don't think there is any scam or any issue that has ever happened on a blockchain, right? Specifically, the what blockchain promises, like, it has delivered on that. For example, Bitcoin, right? You cannot hack Bitcoin, right? That is the case, and it has never been hacked.
Can you clarify what you mean when you say you cannot hack Bitcoin? What exactly do you mean?
Exact. Okay. So basically, what blockchain it is?
Yes, continue.
Yeah. So blockchain is just a network which is distributed, right?
Correct.
So like, basically, we have to go what fundamentally is a blockchain is. So when you do a transaction on a blockchain, it is nothing but a ledger.
Correct.
Right. So basically, it is just records of transaction. A send X money to Y, Y send Z money to A, something like that. And it's just that. It is a database, nothing else.
Correct.
At the end, right? But how that database operates, that is the biggest feature.
Okay.
So basically, that database, like, so all the nodes that are there in the network contains a copy of that database, and new entries are, like, created.
Just one doubt. What is a node?
So basically, a node is basically where the database is functioning on. So basically, your computer or any server.
Who is a node? Who runs a node?
So I can go into that. That there are people who are running their nodes because there is inherently a mechanism which gives them rewards. Right? Everyone is doing it economically. Economic sense.
So anyone can run a node?
Yes.
Okay. So even if I'm not getting a reward, if I want to, can I run the Bitcoin node
Yes,
on
yes.
my laptop?
Yes. So that is proof of work. So you can give your machine or system services to the Bitcoin network, and that network rewards your system.
How does the network reward you?
So basically, this is a concept called proof of work. So basically, we can come to consensus, but let me just complete that previous part.
Sure.
So basically, whenever a new entry is getting created on the database, so the database, it's, so every node that is there, assume like it is a server, right? For now, we can go into that how exactly that happens. So it's Bitcoin has servers all around the world, and each server has a copy of the database.
Correct.
And it's very small because it's just a transaction of A to B, A to B, A to B. So the whole Bitcoin database is very small. So everyone,
How small? Can you give me in GBs maybe?
probably MBs and GBs, not more than that.
The entire blockchain?
Entire.
It's in GBs?
Yeah.
Oh, okay.
Yeah, like something like that. Not thousands of GBs.
And I've heard that
it is very less.
every 10 minutes a new block is getting
Yes.
added. And the first block was mined in 2009.
Yeah.
So there must be
From 2009
hundreds of
to-
thousands of blocks
Exactly.
already.
But like, again, if you see what Bitcoin essentially stores is from A to B, and what is the transaction amount, and more details. But basically, that is the data. It is very light on the Bitcoin main chain itself. So what happens is you add a new entry.
So just a small note on this. Because the data is light, that would mean that basically any person with a laptop or a desktop
Yeah.
can run a full Bitcoin node on
Yes.
their system
Yes. Yes.
and maintain a copy of the blockchain.
Maintaining a copy is the easy part. The other part is difficult, which
What is
is
the other
basically giving your services to the network, because it requires a large computational power to get some meaningful reward.
So when you say giving the services, now you're actually referring to Bitcoin mining.
Exactly.
And it's not the same as maintaining a node.
It is exactly the same.
It is not the same.
It is exactly the same.
When you maintain a node, all you do is you have a copy of the blockchain that keeps getting updated with every new block that is based on the consensus code. But when you mine Bitcoin, you're actually in the race to mine that next block, and you put in computational energy and computational work to convert the bunch of new transactions that you want to put into a block into a form where SHA-256, the
Yes.
encryption algorithm, looks a certain way after taking that block as an input. So there is a difference between running a node and actually being a miner. Being a miner is very intensive as an activity.
Probably this is exactly what it happens, but every miner that there is, so basically there is, for you there is no reward just to maintain a node, right?
Correct.
Right.
Correct.
So that's why like everyone who actually is a meaningful contribution in the network is in mining, because every miner will also maintain a node.
So every miner also maintains a node, but not every node
Node is a
maintainer
miner.
is a miner.
Yes.
And I will make one argument for why there is an incentive to maintain a node without being a miner. Even though there is no reward, there is only a cost that your laptop or your system is lying there and it is consuming energy and internet connection every single second. The reason why someone would do that is if someone has a lot of their net worth, a lot of their money in Bitcoin, then they would want the Bitcoin network to stay secure. And the security of the network is helped by having more and more nodes around the world, because there is no master copy of the blockchain. Every copy is the same, it is all equal. So the more copies there are around the world, the lesser the probability that all copies will get wiped out or compromised in some way.
Exactly.
So you increase the decentralization of the network by maintaining a node. And that would be the incentive for someone who has a lot of Bitcoin, because they have a lot of money in it and they have vested interests.
Exactly.
Okay, continue.
But probably that won't practically affect anything, because there are like millions of people who maintain a node, and like just one more, it actually helps, but practically like that doesn't add up to anything in my mind.
It's a bit like voting.
Yeah, exactly.
Your vote won't change the outcome,
but you have to.
But it adds up.
True. Completely makes sense. Now, when you add new transactions to the ledger, which is basically by the means of mining, right? When you are mining a new block, that is basically voting and like solving a particular block, so that you can add a new transaction, and that transaction needs to be updated to all the nodes, right?
And how does that work? How is every single node on Earth updated?
Yeah. So basically,
you are a miner. Let's assume you are a miner. You mine the new block. What do you do after mining that block?
Yeah. So basically, there is a particular code that you need to decrypt, right? That there is a algorithm for Bitcoin where you can input anything and the output could be anything.
You're talking about SHA-256.
Exactly.
It's not only for Bitcoin, but
so
it is used in
basically
Bitcoin.
Cryptographic algorithm.
Yeah.
So basically, you are given. So basically, each block has a entry node. I forgot that specific term. Basically, a code at the entry and at exit.
Correct.
And the next node will have some entry and exit. So there is some mechanism where it forms a chain.
So I'll tell you how it works. If you have a block here, there's the entry and the exit, or the top or the bottom, let's say.
Yes.
There's a top, there's a middle, and there's a bottom. The top contains the SHA-256 hash of the previous block.
Yes.
The middle contains all the transactions that you're including, and that is up to the miner what transactions they want to include.
Exactly.
If they want, they can leave it blank as well. But the incentive is always to include, because every transaction you get a fee for including it, so you make more money.
Yeah.
Or you make more Bitcoin rather. And then at the bottom, you have an empty space where you can include a string of characters, and the idea is that you keep trying out different strings until you get to a point where a certain string of characters combined with everything else that came before, when you input that block into SHA-256, the output that you get looks a certain way. And the looks a certain way is SHA-256 output is always 256 digits, right? A string of 256 digits.
Yeah.
And it's very random looking, but you want it to look a certain way, as in, let's say you want it to start with 5 zeros. And I'm giving an example here. To make that happen, the probability of that happening is quite low. So you'll have to try many times before you end up with a certain bottom string that will give you the 5 zeros to begin with. And this is the computation energy that it takes. And it is very random. Like, it might seem pointless that why is this built in? But what that does is it ensures that someone has to put in the energy to then mine the
Exactly.
block and then convert it into that hash which looks a certain way, and then every node on earth, when that block is transmitted, every node on earth, because they're running the same code, automatically can verify whether this block is
Exactly.
valid or not, and then add it to the chain.
Yeah.
And the more energy that is going into mining, so the way in which this is designed is there's a difficulty adjustment mechanism such that every 10 minutes roughly a new block should be mined. So if energy into mining is reduced, the given a fixed difficulty, the amount of time it will take to find that right string will increase, and hence it will take more than 10 minutes on average to mine a block.
Yeah.
And then automatically the network adjusts the difficulty. It will decrease difficulty. So instead of 5 zeros, it will be like, okay, 4 zeros are sufficient. And then automatically it will become 10 minutes. And the same for increased mining energy. If mining energy is increasing and blocks are coming out quickly, every 5 minutes, every 3 minutes, then the network will automatically increase the difficulty. Say if 5 zeros are not sufficient, I want 6 zeros to begin with, and then it will become 10 minutes. So that's the block thing. Continue.
So practically, like I know some people who mine and run mining rigs. So basically, like from a business and startup point of view, there are multiple services which you can join. So basically, that is fractional mining. What it is basically block reward is given to the person who finds that string, right? And it's given to one person.
Who mines that block? Yeah.
Exactly. It is not given to all the other person who were trying to mine it.
Correct.
Right. So what happened is that, and the ratio of that reward going to you depends on the computational power in flops that you were trying to give it. For example, there are 100 people. Everyone has one flop of computational power who is trying to mine it for the new block, and then you have yourself has 100 flops. So there are 100 people, 99 people each will have one flops who are mining individually, and then you have 100 flops by yourself. So if you take the ratio, that is 99 to 100, roughly 50-50. So for each block, both of like you getting that particular reward is 50%.
Yeah.
Right. And the other 99 people, each person will have roughly chance of
1 by
half-
100.
half
Actually,
percent.
1 by 200. Correct.
Yeah, half percent.
Yeah.
And you are giving energy, but like it is half percent chance. So in the next 200, 500 blocks, you will get one block.
Maybe. Yeah.
Exactly. Again, probability.
Yeah.
So what happens is all of those 99 people combine their computation power together and act as one.
Yeah,
Right.
I'm familiar with this. Yes.
Yeah, and they act as one, and if they get a block reward, it is split based on the ratio of the computation power they provided.
Correct.
Right. So that is what, like when you have an individual rig, that is how you join it, and then you get reward based on the computation provided, and that translates into energy. So basically you can directly make a link between each block and the total energy you consumed, and then what is the output you're getting.
So anyone
Economics
today,
of mining.
yeah, anyone today can start this thing, this mining as part of a group with their personal computer.
Yeah.
Will it be economically wise to do so? Will you be actually making money?
Yes. So basically, it depends. So basically, there is always an arbitrage between energy and the Bitcoin price, right? At prices of energy at your area and the Bitcoin price. So if you calculate, and there is roughly some percentage that you will be making out of it.
Okay, so it depends on the price of energy in
There
your
is a
area.
margin.
Okay.
There is a margin.
So if the price is low enough, and given whatever probability computation of you getting a block reward, so you can make that mathematics.
Yeah.
You can do the math, and you can see whether or not it is economically feasible for you to mine with your personal system, or to just set up a small rig in your own house and then start mining with it.
You can also calculate. So basically, there are some specific cards. So basically, if you want to mine Bitcoin or any crypto, probably you would need a graphics card specifically, because
They're GPUs or something, right?
Yes. So what we can go into that. So what graphics card does it do a lot of computation for that SHA algorithm and tries to find it in a loop. So basically parallelly,
Yeah.
tens of thousands of calculations per second, and it keeps doing it until it finds it, right? So everyone is using their GPU to find that specific thing.
That makes sense. I just wanted to talk about block reward a little bit.
Yeah.
How does block reward work? What is it? What is its role in the entire network?
Yeah, I specifically don't remember much about it in depth, like technical depth. So if you specifically know, like you can answer it, but specifically what it is so basically basically it is a reward for you to add the new transaction and basically new transactions on the database after verification, right?
So adding a block.
Adding new transactions, and when you make a transaction, there is some fee that is cut from the transaction. So if you send, like for example, 100 rupees, 100 Bitcoin to someone, they will probably get 99.999 something, right? So there is some fee that is taken out by default by the blockchain, and there is an algorithm for it as well to reward miners, so that it's a self-fulfilling circle which is completely independent of supporters. Basically, you don't need anyone to support and maintain a blockchain network. Blockchain network takes fee from its users and gives it to its providers.
Okay.
Automatically.
If I'm a miner, my incentive to mine Bitcoin or any other cryptocurrency would be the block reward I get at the end. And that block reward is in the native currency. So if I'm mining the Bitcoin blockchain, I get Bitcoin at the end of it as a block reward, and I get some Bitcoin as transaction fees if I include transactions in the block. So the incentive for mining depends on the price of Bitcoin as well, or the price of whatever native currency you have. If
because
the price
the
is
block
high,
reward is given in Bitcoin.
Yeah, or the native currency.
Yeah.
So if the native currency has a very high price, then a lot of people will be incentivized to mine it, which is the case with Bitcoin, which makes it secure then.
Yeah.
So the way the block reward works is, and a lot of people ask me this, how can you say that the supply of Bitcoin is fixed when more and more is being mined all the time? And the way this works is, imagine, you know that Bitcoin has 21 million in supply. So imagine this is 0 on the day you start, and this is 21 million. Initially, the block reward, so for the reward for mining every block was 50 Bitcoin. That's what it started off with. And after 210,000 blocks, that reward was half to 25. And because it's roughly 10 minutes per block, so 210,000 blocks would take roughly 4 years. So we'll talk 4 years from now on. So roughly every 4 years, the network automatically, so after every 210k blocks, it halves the block reward. So it started off with 50, and then it became 25, then 12.5, then 6.25. Right now it is 3.125. So the last halving happened in early 2024, if I'm not wrong.
Yeah.
So
that makes it every 4 years, right?
Every 4 years.
Every 4 years, then it makes it double the worth every 4 years.
This is a very interesting consequence.
No, not double, but a function of basically. So basically, it will try to go to double every 4 years, but then the cost of mining also reduces because of technological improvements. So it's both. So that's why, like, it can basically become stable as well, because if every 4 years, if we increase there is a law in computation as well, where every few years the computation power doubles, right, and the size reduces as well.
The size of a chip.
And
how many these things you can fit into a chip? Is it transistors? Yeah.
So right now, like, we are at the quantum level, we have reached already. So that's why, like, there is a lot of development going into the quantum, because we already reached around 2 nanometers size of transaction.
We'll get to quantum soon, but I want to talk about the incentive structure here and the game here, because the block reward rather, is halving every 4 years. And I know it's more complicated than this, but assuming, and this is the wrong assumption, but assuming that the mining energy and the mining computation that is going into it is the same, then there will be a natural push to double the price of Bitcoin, at least double every 4 years. But actually, and this is because the cost of mining has not halved suddenly,
But the rewards are up.
but the reward is halved. So the venture, for the mining venture to be profitable, you will need double the price.
Exactly.
And because that doesn't happen in such a smooth fashion, because there are more fluctuations, Bitcoin still has followed roughly a 4-year cycle. This cycle might be different, but we'll find out. Because that doesn't exactly happen, you see a lot of miners getting wiped out, getting unprofitable
For some
after
periods.
the block reward halves. Every time it halves, this happens. A lot of miners get wiped out. But also,
So to keep the Bitcoin blockchain safe, its price needs to increase. Otherwise, there is no value.
that's an interesting argument. Because if the price is not increasing and every 4 years the block reward is halving, so every 4 years,
And assuming the computational cost is the same, that is a very big assumption.
but computational cost should actually reduce.
Yeah.
So there will be more computation going in at the same cost.
So basically, the cost of computation reduces
Correct.
Constantly, not in the cycle of 4 years, and the block rewards is halving every 4 years. But probably, like if we hit a wall in a few years,
What wall?
computational wall,
Computational wall.
prices.
You were talking about quantum computation, and now you're saying we'll hit a
Technologically, if we hit a wall and
Okay.
we say that okay, we cannot reduce prices like for 10 years, the cycles change, right, for tech. So in 10 years, like you reduce the cost of computation by half, but block time is getting half every 4 years. So that like you can again make interesting observation on that how will that fold out. Uh, because like the reward will half, then the if you can calculate that how much the price needs to be increased so to keep the blockchain safe, so there you can estimate the price of Bitcoin, and there you can calculate a level that okay, if it is above that level, Bitcoin is safe. If it is below that level and mining is unprofitable, then probably it is not going to be safe for a long.
Let's actually play out a scenario. Let's take a bearish scenario where for a period of, let's say, 12 years, because every 4 years, so we'll have 3 cycles.
Okay.
For a period of 12 years, there is no improvement in computation. Okay, this is bearish.
Okay, no, so I again like got a insight. I just remember that the difficulty lowers, right? If not many people are doing it.
Yeah,
that-
so I was going to include it,
so
but let's go
that
through it
solves
anyway.
itself.
That's the beautiful thing about
Exactly, yeah.
Bitcoin. Every possible scenario I've tried to imagine where something can go wrong, I realize there are incentive structures or there are corrections already built into the system.
Exactly.
It is incredible.
Yeah.
So let's still play
That's
out
the
the
beauty,
scenario.
right?
12 years, zero improvement in computation power. Zero increase in price. Price is basically flat. Okay. What this means is every 4 years, the number of miners who are profitable, or rather the mining energy that is still profitable, the mining computation will halve, because the block reward is halving. So the dollar value or the rupee value of the earnings of a miner is halving. So half the miners will have to drop out, and then half the miners will have to drop out.
Then there will be some balance that will be naturally stuck.
What will happen basically is that the computation difficulty will be adjusted automatically to make it easier to mine. So the blocks keep getting mined. So that is not going to be a challenge. I think the challenge there will be like if this continues for long enough. I'm giving you 12 years and I don't think that will happen. This is just hypothetical. But even over 12 years, if you have half and then another half, so you have 3 cuts by 2, so you have 1 by 8.
The number of people who are maintaining becomes a lot less.
So the mining energy going into it is a lot less, and then the blockchain becomes vulnerable to a 51% attack. And that is the only vulnerability that any blockchain can have that is truly decentralized. Most blockchains claim to be decentralized, but I have high suspicions around that. Bitcoin is decentralized.
It's completely decentralized.
But if there is not enough mining energy going into it, it would become easier for a bad actor to come in with 51% of the energy, 51% of the computation power, and then try to beat the honest blockchain with a dishonest chain.
Yeah.
That is the only risk with it.
Yeah, exactly. Like if people who are mining get centralized, mining of Bitcoin should not get centralized, right? So if that gets centralized again, then the people. But then again, like if I think it needs to be like a very covert kind of thing, because if the other people got to know that okay, someone is getting all, because it's completely on a ledger, right? Who gets the block reward, and if some person is consistently getting block rewards, then it is 100% that they have like hacked the mining or hacked the blockchain, right? Then
Not hack the blockchain, they have most of the
they
mining
have-
energy.
exactly, right? So then you can probably theorize that okay, that this blockchain is not the honest one. So you can come up with some calculation that okay, if 3 blocks goes to the same person in series, then probably that person has the most computation power.
Okay. But if I am a person who has attacked Bitcoin in that way, who has most of the mining energy, I
You'll
won't use
probably-
the same
yeah,
address.
exactly.
I will use different addresses
So-
who all belong to me.
True.
So there's a way. But just to give you a sense, do you know how much energy is going into Bitcoin mining currently?
So 3 bitcoins is the reward for each block, right?
3.125.
3.125
And every 10 minutes.
every 10 minutes. So every 10 minutes, probably 70% of that cost.
Okay, so you're talking in dollar terms.
Yeah.
How much the cost of mining is going in?
$300,000 per 10 minutes.
That is a lot.
That's a lot.
I know.
Or probably less, 250K.
Okay, but
300K.
some percentage of the total block. That is actually a very interesting way to arrive at energy going in, because if I look at a miner has fixed cost and variable cost. The fixed cost is the equipment, the rigs.
Equipment.
The variable cost is electricity. So the profit loss statement of a miner, the P&L of a miner, will depend on how much Bitcoin they're making. So the price of Bitcoin in their currency, whether it is dollar or rupee, and the cost of electricity in their currency. The input is Bitcoin in their currency, output is cost of electricity, and you want input to be greater than output.
Yeah.
So your math, that's a very interesting way to do
Yeah,
the
like
math.
probably it would be around 50%, 40%, 30%. It can be anything.
depends on the profit
overall.
margin.
Yeah, it is very dependent on how each person run its operations, each rig is, and what chips they are using. For example, if they are using older chips, then that would be much more computationally like power hungry. That's why again, every few years a lot of chips are on market, on the like second-hand market, because they are because the new chips are basically more profitable to use after that fixed investment, like every few years, because that the new chips are that much efficient.
Makes sense. That makes a lot of sense. What I was going at, or the angle that I come at it with is, and this is the last time I checked, it would be probably higher now. Bitcoin mining takes up 0.4% of all human energy consumption on the planet.
That is again an interesting number.
0.4%. So what that means is, if you want to make a 51% attack on Bitcoin today, you will have to amass more than 0.4%. No, because 0.4% is honest.
already there. Yeah.
Yeah.
More than 0.4.
So you will need to amass more than 0.4% of the total energy today, and then direct all of that, and you will have to amass a lot of computing power as well, a lot of ASICs and rigs, and you will have to direct all of that into dishonestly mining Bitcoin.
Yeah.
And even then, as you said, if there's an honest chain that is working on a certain consensus code, and someone starts a dishonest chain, someone tries to do a double spend, let's say, in the most latest block, they spent their Bitcoin and they got a service in return, but they want to mine from the previous block and create a newer, longer chain, so that their spent Bitcoin is actually still with them. If someone tries to do that, it will be obvious to everyone, every single node, And even if they manage to amass 51% of energy and 51% of computation, and they make a longer chain, a chain with more work done compared to the honest chain, the people who are in this space know that this will soon be rejected.
Yeah.
So honest miners and honest nodes will still keep working on the main chain, even if for some time it is not the longest chain. Eventually that dishonest chain will be discovered and disreputed. So whoever it is that amasses all that energy and all that computation to try to attack and make Bitcoin fail will end up spending billions, if not trillions of dollars, and achieve nothing.
So how is the process of rejecting a chain happens?
Rejecting as in, suppose there's a honest
there
block
is
happening,
honest block
and
happening.
someone tries to mine a block that is not a continuous one, that is a fork in some way. The node operator can see it. So they don't have to reject it in the sense. If I'm a miner and I see that someone has created a block that is longer, but
No. First of all, you won't be able to differentiate between the honest and the dishonest chain until he does something which is you can figure out, right? Basically, what you would say is that there are two variations happening.
But the fact that someone is not continuing on the main block and trying to branch off is already.
But that itself is the main block now.
Yeah, so technically that might be the main block, because now let's say it's the longest block. Okay, that guy is mining more blocks quickly than anyone else, than the honest group. Like that guy has 10% of the world's energy, let's say, and you are at 4.4%, everyone else combined. So that guy has the longest chain.
Yeah.
Fair enough. Technically that is the main block. But if I am a miner, if I am a node operator, I can see the guy didn't continue on the honest chain, and the guy tried to ignore a block from the main chain and start before it. That's the giveaway. That is how a miner or a node operator would know that this guy or this person, this entity, has bad intentions.
Okay.
And that's how they will make a decision, that's how they can make a decision to continue mining on the honest chain. So you always have a choice where you want to attach your mine, because when you have that block, you have the top
what
shard
is the
of
latest
56. So which one do you want to attach it to? You have that choice. So honest miners will keep attaching it to the honest chain. The dishonest chain, because there have been other folks as well. There was Bitcoin Cash. There were other folks where they were not dishonest, but they followed a different consensus. But people who were dedicated to Bitcoin, people who were philosophically inclined with the vision of Satoshi, they continued mining on the honest, on the original chain. And the other folks there have multiple attempts to fork Bitcoin, and they've always become worthless. So anyone who's in this space knows that the incentive for anyone who's coming in, or the incentive for any existing player as well, is always to stay on the honest chain. And if I have the resources, I'm a government or I'm some very rich entity who has the resources to bring together 0.4% of the world's energy and computation power today, I have every incentive to just use that to mine honest blocks and make more money out of it. I have no incentive to try to cheat the system, because the system punishes you when you cheat it. That is the beauty.
But for example, if you have that much energy, and so basically you can see that Bitcoin as a chain thinks that the computation power its different actors are holding are like voting powers, right? That what will happen on the chain.
Make your point and I'll agree or disagree with your analogy.
So basically, Bitcoin as a chain sees that what is the percentage of different people so basically the percentage of people with compute who are blocking the rewards is more like voting power, right? That okay, if you have one flop and everyone has one flop, you have 1% of power. And if 51% or more than 50% of you decide that okay, we need to change blockchain, change Bitcoin, and this needs to be changed because, for example, you found a major flaw in Bitcoin after some years, then democratically people can think that okay, we democratically decided that we are updating this, or there needs to be some change, and now this is the new honest chain.
So this has happened multiple times. It's called a soft fork, and this is actually quite interesting because let's say a soft fork is happening, and when it gets called a soft fork is also something that is decided by history later. When it is happening, you never know what the outcome is going to be because now the block has split in a way. The chain has split. Whenever there is a change to the consensus code, the impartial deterministic code that determines whether a new block will be accepted or not, right? Whenever there is a change to that, there is always two different coins, you can say, or two different blockchains that are created, and now it's a free market, and the free market decides which one is worthy.
Yeah.
What happens in a soft fork is there is something close to a universal consensus that, okay, we want to do this, we want to make this change happen, let's all change towards this. And then, and I'm not sure about this, but then I imagine if there's universal consensus, then there would be no split in the blockchain, that the blockchain would just bend in a way. And it's not literally bending, it's figuratively
because
bending.
basically all the people who are mining in the previous version would not continue to do so.
Yeah, if everyone switches over, then there would be no
splitting.
continued block with the previous version. But if otherwise some miners choose to go off, and they often choose to go off, that's called a hard fork. And all hard forks have failed because the free market recognizes that the value lies in the original chain. The value lies in having 21 million coins, and 21 million coins only. The value lies in having as little data per block as possible, so that the size of the total blockchain is small, so anyone anywhere in the world with a simple laptop can run a full node. And that is what keeps the blockchain decentralized.
Exactly. Now if we come to specific problems that Bitcoin have is